Well, good afternoon, everybody. My name is Mark Zaidi. I'm the Executive Director for WisMed Financial, which is part of the Wisconsin Medical Society. And I'm really excited to bring in some special guests for us today. So we've got Patrick Carroll, Sean Swenson, and Jamie Steffen here from Investors Associated. This is a very interesting company, and Investors Associated got started way back in 1979 by a group of physicians who wanted to invest in and own the clinics that they were practicing in. And so today there's over 150 partners, and there's more than 30 properties. I think it's actually up to 45 properties, if I'm not mistaken, across multiple states, and in the hundreds of millions of dollars worth of real estate that Investors Associated manages and operates today on behalf of their shareholders. And so with that, we're going to go through a variety of ways to invest in real estate. We're going to talk about different types of accounts, and then I really turn it over to the folks from Investors Associated to walk through a handful of different real estate options and benefits, et cetera. And then we'll wrap up with some personal real estate strategies, such as rental properties and even just simply paying off your own home. So we're going to go through the whole gamut today. But before we get into real estate, one of the things I do want to point out is that you do have multiple ways or multiple accounts that you can use to invest in real estate. And so in some cases, you can use tax-deferred money. You can use your tax-free Roth accounts in some circumstances. But for the majority of folks, it ends up being inside of a non-retirement account. And so as we go through the presentation today, anytime that you hear of any tax benefits or tax drawbacks, that's going to be when you own real estate outside of any retirement account. So not in an IRA, not in a Roth IRA, but really just owning that directly. And so with that, I'm going to turn it over to Jamie to start walking us through the real estate benefits.
Thanks, Mark. Before we dive into the different types of real estate investments, let's take a quick look at the advantages. There we go. Advantages and disadvantages of adding real estate to your portfolio. Diversification is a strategy that reduces investment risk by allocating the investments across various investment instruments. By adding real estate to your portfolio, an investor can utilize a diversification strategy and its advantages, such as reducing the impact of market swings on a portfolio and achieving strong portfolio balance brought by different market sectors. Real estate also provides the advantages of long-term growth rather than short bursts of income. Tax deductions, which Mark mentioned kind of earlier, tax deductions through depreciation and amortization, and rental income, which Mark will highlight a little later. Just like any other real estate investment type, real estate does have its disadvantages. Capital gains, which are paid upon sale, they can be cumbersome to manage directly. There are long-term growth rather than quick bursts of income, which I know I mentioned this as an advantage, but some investors do see this as a disadvantage if they're looking for those quick bursts of income. It can be difficult to qualify for a real estate investment. Additionally, there can be a lack of access to real estate investments. And finally, some are less liquid. As real estate investment advisors and managers, we find that these advantages do outweigh the disadvantages when it comes to an investment portfolio. So I'm going to turn it over to Patrick now, who will talk about the first type of real estate investment opportunities, which are publicly traded REITs.
Thanks, Jamie. Just request control here. Oops. So one of the most common ways individuals invest in commercial real estate is by investing in REITs, or what are known as real estate investment trusts. And so a REIT is a trust that is afforded certain tax benefits within our Internal Revenue Code. One of the most notable benefits of being a REIT is avoiding double taxation. The REITs do not pay taxes at an entity level, and the owners of the REIT pay taxes through pass-through income earned at their ordinary tax rate. However, in order to enjoy these benefits of the tax rules, a REIT must satisfy certain requirements under the Revenue Code. And I listed some of the high-level requirements here. You can see 75% of their total assets have to be invested in real estate or cash. 75% of their gross income must be derived from rents, interest on mortgage financing of real property, or other real estate related matters like sales or dispositions. 90% of their taxable income must be paid in the form of shareholder dividends annually. They have a minimum of 100 shareholders and this 5 or fewer rule, so that there has to be a minimum of 5 shareholders owning 50% or less of the REIT, and the shares must be transferable. And so many of you may still be asking yourself, what is a REIT? So if we look, conceptually, a REIT is basically an entity that owns, operates, and or finances income producing properties, commercial properties. The majority of REITs invest in commercial real estate and all sorts of kinds, and we'll get into that in a minute. And they derive their income from the rents and the capital gains from investing and selling real estate. Some REITs are focused only on the mortgage side, and their business model is earning interest from their investments. And an even smaller group of REITs do a little bit of both. The majority of REITs are publicly traded stocks, which make them highly liquid when compared to other real estate investments. There are also privately held REITs who still must comply with the Internal Revenue Code rules in order to enjoy the tax benefits. But those privately held REITs are not traded in a market like the New York Stock Exchange. And so when we think about the REIT universe, if you are generally comfortable investing in stocks and want to add a real estate component to your portfolio, REITs can be a good route. But the next question becomes, what type of real estate do you want to invest in? Most REITs are specialized in that they focus on one type of real estate, whether it be office, multifamily, retail, industrial, hotels. But what you'll find is that in order to distinguish themselves from their peers, each REIT has become further specialized over time. If you look at the multifamily sector as an example, there are subsectors in there, including market rate apartments, student housing, manufactured housing, and single family residential REITs who are solely focused on renting out single family homes. Similarly with retail, retail isn't just retail. There are mall REITs, shopping center REITs, there are grocery anchored focused REITs, triple net REITs as well. And then also within the REIT universe, there are what are known as specialty REITs, REITs that focus on investing in farmland, in prisons, in gaming, in casinos, data centers, timber, self-storage, etc. And so this is just to give you a little flavor of, okay, I like real estate, I want to invest in a REIT. You have to start to think through which one of these REITs, which one of these philosophies do you believe in or buy into. In addition, within each sector, each REIT is trying to position itself to be further unique in its location. So some may focus on gateway markets, the New York, LA, Chicago, Miami's of the world. Some may be more focused on tertiary markets. Some may decide that they're only going to invest in the Sun Belt. In addition, there are some that self-manage or are internally managed, and some that are externally managed, meaning that they would hire a third party to manage their properties. Historically speaking, an externally managed REIT has been disfavored because there's a perception of misalignment of interest between the property owners and the property managers. And so there's a number of things when you dig into investing in REITs just to be aware of and to understand what their strategy is, what their philosophy is, and make sure it's matching what you're trying to do with your investments. And so if we turn to the next slide here, we will see some high-level pros and cons of investing in REITs. There are a number of benefits to REITs, namely they are probably the most liquid real estate investment because you are usually buying a publicly traded company on an exchange. As a result of being a publicly traded company, REITs are one of the most transparent in terms of their pricing and value information about their business. As a result, the market will dictate the value of their company and the real estate. Because of the REIT rules with the Internal Revenue Code, REITs generally provide stable cash flow through their dividends, although some REITs are more focused on growth and growth potential. REITs also provide a way to invest in real estate without being the direct owner or manager. You know, as a REIT shareholder, you're not getting calls when there are issues with the plumbing at the facility or trying to find a new tenant to lease up the space. It is a passive way to invest in some commercial real estate. A few of the drawbacks for REITs include limited upside on capital appreciation because of that dividend requirement we've discussed. Those dividends are typically taxed as regular income. And there are fees associated with every activity that the REITs do. They charge fees for acquisitions, dispositions, loan renewals, lease signings, asset management, and all of these fees eventually take away from potential upside in the investment. And so if we turn to this next slide, we can see just generally some long-term performance for REITs. Historically, REITs have performed pretty well. You know, since the 1990s, the up cycles for this sector have been at least 7 years, and the down cycles have been about 2 years, but are more pronounced and often associated with larger market contractions. From 1990 to 2021, the total return for this for REITs have been about 12%. So just to give you an idea of how they've performed historically. And if we turn to the next two slides, I just wanted to give you an idea if REITs are of interest to you. There are a couple ETFs that are relatively safe investments. Both the Vanguard Real Estate ETF here that's showed now, you can see they have top 10 holdings are in some blue chip, traditionally blue chip REIT stocks like Prologis, American Tower Corp, Welltower. A lot of these are focused on industrial. We have some specialty REITs on cell towers and communication, as well as some data centers. And again, it's a relatively diversified ETF. The second opportunity, if we turn to the next slide, is the iShares US Real Estate ETF. Again, you'll see a lot of the similar top holdings as the prior Vanguard REIT, and you can see their diversification across sectors is pretty heavily focused on specialized residential and industrial. So with that, I will now turn it over to Sean Swenson, who will talk about the private investment side of commercial real estate lending.
Thank you, Patrick. Appreciate that. I think I've gotten control of this. Let's see here. Maybe. There it is. So Patrick did a really nice job talking about REITs and publicly traded companies that you can invest in as a real estate investor. I'm going to go a little bit of a different direction and talk about private placements. And there's a number of names you might hear talking about these private investments, syndications. You might hear somebody talk about a private placement memorandum or a PPM. You can see there on the screen. So this is very different from a REIT in a sense that these are generally not advertised or very little. There's SEC solicitation rules that apply to that. And many times, and I would say most of the time, these kind of investments only apply to accredited investors. There's some exceptions. So at a high level, accredited investor is somebody that makes $200,000 a year, $300,000 as a family, or has $1 million in net asset, not including your primary residence. So these can be sourced through financial advisors, but oftentimes it's through word of mouth. You'll know somebody that knows somebody that had invested in a deal with somebody, and that's how you kind of get connected to that world. Now, recent years, it's changed a little bit in terms of crowdfunding. So there's a different set of solicitation rules that apply, but crowdfunding companies such as Fundrise, Realty Mogul, Crowdsource, there is some ability for them to advertise. Maybe you've seen emails from these companies. We'll talk about them a little bit more later, but generally speaking, what they're doing is finding potential accredited investors and sponsors who have real estate deals, and they're kind of marrying those two up, and they work in the middle. So that's kind of how they do it. And as we'll get to later, there's a little more uncertainty with that kind of deal. But let's move forward and talk about types of deals. This is a very, very high level. When you invest in these private placements on the real estate side, Many times you're investing in a single asset investment. So somebody's building an apartment complex, a new hotel, they're buying an industrial building, and you are investing in that deal and that deal alone. We'll get to some pros and cons with that. The other option oftentimes is a private real estate fund. That fund could be many, many deals across different property types here. I have kind of all the main food groups listed: apartments, shopping malls, residential, and so on and so forth. Or it could just be a small pool of properties as well. Maybe it's 5 industrial buildings in 5 different cities. One thing I'm going to talk about often through this short presentation, and Patrick mentioned it too, is understand what you're looking for. Same thing here. Are you looking for diversification? Are you looking for a single asset? And we'll get to the next slide here and talk about some of the pros and cons, some of the key differences. So again, type of asset, single asset, we talked about that. It's one asset. One thing to think about is there's a wider range of outcomes. Okay, so if you invested in recent years in a new apartment construction deal, there's a chance you had a very, very strong return. If it was in the right market, timing was right, and everything worked in your favor. A fund, likely more diversified, and should lead to a narrower range of outcomes. Go back to that single asset. Let's say that deal didn't go well. If that's what you're invested in, your return would be potentially not good or even negative. You could lose some money. With a fund, think about it, if you have 50 properties in the fund and something were to happen to one of the properties, either really good or really bad, the impact is muted. So again, what are you looking for in a real estate investment? Capital in, capital out. You know, in contrast to the REIT world where you're buying and selling stocks, there's a lot of different options here. The most common structure with a single asset investment is you put your cash in up front on the purchase or on the upfront development. You receive distributions a lot of times when the property produces cash flow, and you're along for the ride. You're probably in it until the property is sold. At times there's some exit rights, but most of the time you're with this asset until it's sold. If you look over to the fund, there can be a lot of different options here. You may have an opportunity to redeem some units, some or all of your investments. That's how Investors Associated operates. And there may be some cash distributions, there may not be. So again, understand how that works. Tax impacts, Mark talked about tax a little bit earlier. Generally with a single asset, you're going to get a taxable loss in the early years because most developers and sponsors will use accelerated depreciation methods. So even if you're collecting cash flow in the early years, you will accelerate the depreciation and you'll show a taxable loss. For the first couple of years. Eventually you will show a taxable gain if the property is successful. With a fund, there may or may not be taxable loss. I said inquire with the sponsor. A lot of times because of the size of the fund and development, new acquisitions, there could be an impact there. That's kind of a high overview. So now we get into the questions. What kind of questions should you be asking? This is something that people ask me, and I always say the number one question is, who are you dealing with? You know, who are the people? Who are the sponsors? How long have they been doing this? How did you find them? Were they recommended? Were they vetted? A lot of times, if you find a good sponsor in real estate, if there's hiccups that arise, it could be large problems, small problems. A good sponsor will know how to execute through those issues. And that's why knowing who you're dealing with and seeing if your interests are aligned with theirs is really the most important. So let's go back to that crowdfunding example. You could find alignment, certainly, I would think, in a crowdfunding example, but I would say it's harder to know who you're dealing with in a scenario like that versus if you had a direct relationship or maybe you're 1 or 2 people removed from the actual real estate sponsor. Regardless of understanding who the people are, one thing to always remember, we talked about the PPM, which is a private placement memorandum that lists the deal, all the risks. Make sure you read the PPM. It can be heavy reading. It might take a while to get through it. Or if you have a financial advisor you trust, have somebody read that PPM, because there's a lot of information oftentimes in those pages that can help you decide if the investment is right for you. What else should I be asking? I think this is a good thing for me to bring up. Been doing this kind of thing for a while, and I would have potential investors ask me, what else should I be asking? It's a simple thing if you don't understand how these deals work. So just a couple of highlighted questions I threw on here to discuss. Sponsor and fees. Every one of these deals, the sponsor is going to charge fees. A lot of times there's a free interest in the project. Many times it starts with as the property begins to cash flow, the investor would get an 8% preferred return, and then anything after that, it's split, say 70% to the investor pool and 30% to the sponsor as kind of a free interest, so to speak. And you will see at times sponsors ask for larger fees. I had a friend of mine show me a deal he was looking at. He was down in Atlanta, looked like a good deal, but the split was a 60-40 split. And I told him, you should maybe go back to these guys and say they're asking for a little bit too much. And it turns out that he wasn't the only one. So it is good to know somebody that's seen these kind of deals that can help you understand what kind of the normal deal is, so to speak. Track record, we talked about that. How long have you been doing this? Have you operated through different cycles? If you're in a hot cycle and somebody says, yeah, I've been doing this for 5 years and all my projects have been good, they probably never dealt with any challenging situations before. And you don't have to have the longest longevity, but if there's a team in place that understands how to navigate through tough times, that is important. Overall leverage, this is a big deal. In Investors Associated, we're a lower leverage real estate investment. If you have higher leverage or a higher loan to value, a lot of times you can show a higher return if things go well. That might be what you're looking for. You're looking for that home run. Lower leverage oftentimes lowers your return, but also lowers the overall risk. I think that's an important thing to always take a look at. Who do I call? I like this question a lot. I've been on some calls with Jamie and sitting with some potential investors, and they say, who do I call? And Jamie says, you call me, because if you're with an investment for a number of years, you're going to have a question about something. And in these kind of private deals, it is nice to have a number you can call to ask questions and get through that. How do I exit? This is a big deal. This is about the liquidity. Again, with Patrick talking about REITs, the liquidity, you buy and sell stocks. It is a little bit more challenging, oftentimes with these kinds of deals. Are you along for the ride? I would tell people in past positions of mine that you might have to be stuck with this deal for 40 years. There's no short-term plan to sell. Just make sure you understand that and understand what direction the plan is and how you can get your money out if you'd like to. And the last thing I didn't put on here, but I thought about as we were just honestly, as I was listening to the presentation, is where's the property located? A lot of times investors, nice thing about real estate investments is you can kind of see it. You can drive by it. Maybe if you live in Milwaukee, you're interested in Milwaukee area deals because you want to be able to go see your investment. Maybe that's not important to you, but just something else to consider. So that's a kind of high level of what to look for in private placements. And with that, I'm going to hand it over to Mark, who's going to talk a little bit more about direct investments.
Right. And so I get this question quite often from people that want to do their own real estate. They may want to own some a duplex or their own rental property. And so I'm going to walk through a few of the items that I see pop up from time to time. So a couple of different options there. Obviously, the straightforward rental where you have tenants. It could be a vacation property that gets rented out from time to time. A lot of times it is self-managed. Perhaps you do have a management company to help out. One of the keys here, though, is the legal entity. It's really important to protect yourself from any lawsuits that may come up from your tenants. And so an LLC is quite often used to separate that property and own that property, so that if there are any issues with any tenants, they would be actually putting a claim against the LLC and not against you personally. And that keeps your personal assets separate and protected from the assets of the LLC. Now, we do have to pay some income taxes on here. And basically the way that it works is it's the net income that you receive. So rents or lease payments that you receive minus expenses minus depreciation. Depreciation is basically a tax calculation. If you think about a vehicle, obviously depreciation of a car is pretty easy to understand. The same applies for real estate, even though the value of real estate may go up. Some of those business expenses are really itemized here on this tax schedule. So you see advertising, auto and travel, cleaning and maintenance, any commissions or insurance. So there are a whole variety of business expenses that can be deducted as an expense in the course of owning that real estate. Now, when that rental property does eventually get sold, we have to be aware of a potential depreciation recapture. And so let's say that you buy a property for $250,000. over time you've written off or you've depreciated $30,000 of that. In other words, you've actually reduced your taxable income by $30,000 over time, giving you a $220,000 basis in the property. And if you sell it for $300,000, what happens is we have this depreciation recapture. So getting back up to your original cost of $250,000, we recapture that $30,000 of depreciation that you were able to write off in your tax returns over the years. Tax rate on that is up to 25%. And then the remaining amount from $250,000 up to the $300,000 sale price is treated as a normal capital gain in this sense. Now, what about your primary residence or second home? You don't have to worry about taxes when you sell your primary residence. There is a primary residence capital gain exclusion amount. It's $250,000 or $500,000 if you're married filing jointly. However, this can come up if you are selling a second home where you may have some capital gains to pay there. And so, oftentimes the strategy, at least historically, used to be, well, if I have this rental property, what if I just move into it and turn it into my primary residence? Can I get rid of the taxes that way? Because now I can use that primary residence exclusion. And the answer used to be yes, but the answer now is typically no. During the time that property was considered a rental, you would have the capital gains and depreciation, potentially a depreciation recapture for the period of time that it was considered a rental, but not for the time that it was considered your primary residence. So with rental property, a couple of rules of thumb here. First is the 50% rule. You want your mortgage payment to be no more than 50% of the rental income. So let's make sure that there's enough positive cash flow coming in to take care of things like repairs for times when there may be it may be vacant and we don't have a tenant. So we need to have some cushion there. The 1 or 2% rule helps out with this, meaning that the monthly rent that you receive should be at least 1% of the purchase price, but ideally closer to 2%. The higher that you can have that monthly rent to the purchase price, the more positive cash flow that you'll likely have coming out of that rental property. And then finally, for people that are thinking about buying a property to do some remodeling and flip it, you want your after repair value the total cost should, in most circumstances, be no more than 70% of the after repair value. So in other words, if that property is going to be worth $200,000 on the open market when it does get sold, try to spend less than $140,000 between the original purchase and any upgrades that are done. Now, all of this being said, one other way to invest in real estate is simply, hey, pay off your own home. There's some big advantages there. Maybe you can get rid of your primary mortgage insurance. Reducing your own living expenses now frees up cash flow for other things that you may want to spend on. And so there's, we can't discount the value of just simply paying off your own mortgage and owning your home debt free. And so I'd like to stop there and open this up for questions while we do have some of the experts here from Investors Associated. So feel free to come off mute or jump in the chat. Otherwise, if you do have some follow-up questions for either of us, the contact information is on the screen for myself as well as for Jamie. Otherwise, thank you for joining us today, and I wish you a great rest of the day, and we'll open it up for questions.